So first thing before we forget, I think we just need to point out that obviously the views expressed by all of us here are our own and not necessarily those of the institutions that we represent. All errors, omissions, etc. our own. So what we're talking about here in the first instance is capital requirements that banks have. So if you're a bank of a certain size, pretty much everyone, you need to be able to measure your risk. So and your capital requirement is based on that, and then obviously you need the capital, the loss absorbing capital, to actually meet that requirement. And of course you need that for different types of risk, being credit risk, market risk, counterparty risk, and operational risk. So what we're talking about here is market risk capital. Now, how does that work? Of course, as I said, there are two sides. There is the capital you have, which is something similar to shareholders' equity on your balance sheet, although it's a little bit different for regulatory capital because you can count certain types of debt towards that capital, but that's sort of what you have to absorb your loss, and you've got different quality of capital and so on. And on the other side, there is a regulatory prescribed way to measure how much capital you actually need. And that's what we're talking about here. Now, there are two main ways that regulators let banks measure their riskiness. One is called many things, but it's usually known as the standard method. So this is a very prescriptive way of saying this is for every asset class, for every category of position within that asset class. This is how you measure riskiness, and then this is how you come up with the final number that you then have to hold capital against. If you're a bank of any size and complexity, you typically use the other option, which is to use internal models. So you are allowed to use your own risk models, subject to deep regulatory scrutiny and approval. But it's basically your own model, typically value at risk models that you then approve to use for all or part of your trading book, typically, to measure your riskiness. So FRTB, the Fundamental Review of the Trading Book, is a proposed revision. It's a new standard on how to measure your capital requirement. It covers both the standard side and the model side, and there are very major updates to both. And there are also updates to what's in the trading book, what's in the banking book, how do you classify it, internal risk transfers. There's a whole host of things which we'll talk about as we go on. Maybe just quickly before I move on to my fellow panelists, having been a regulator, there are several reasons regulators propose updates such as this. Typically, in this case, maybe the main reason, and disagree with me if you like, but at the moment, if you're a big bank with an internal model approval, you typically get a lot of capital benefit for using that model. That means that if you lose permission to use that model, your capital requirement goes up by several factors. And of course, if you're a big bank, then regulators are not really able to just use that nuclear option, because you can argue, I'm going to go out of business, it's not good for stability, and so on and so on. So regulators at the moment, even though most banks have significant issues with their internal models, it's not really a credible threat to say, well, no, we're just going to pull your model permission and you go back onto standard rules. So that's one of the main issues that regulators are trying to address with FRTB. So and it's been coming for many years, but they're trying to have a less of a cliff effect between standard and in internal models. Now, I think the trouble with that, and this is a good way to move on to the next question, the trouble with any new set of regulations is that when you're trying to fix things, you can quite easily have unintended consequences, particularly with a very technical set of regulations, and that's why the industry has been having a lot of problems with it. So let's move on to our first question, which is
Neels, before you do that, it might be worth mentioning. I mean, in terms of scope, this actually isn't a big deal for banks, relatively. For most European banks, market risk is under 5% of their overall risk-weighted assets. So we're talking about a fairly niche chunk. So you become even more exclusive in being here and being interested in it. Probably one of the things.
That's a good point. So it's a tiny bit of overall capital, but technically it's a very big deal.
I agree on the point, but still, though, it's definitely it's a massive problem for market risk for banks, for big banks especially, right? So where you have a lot of trading book activity. So definitely, yes, it's just 5%, but for a big bank with trading activity, which sell a lot of products, it's a big problem. So it's a lot more money a lot more capital to think about. So definitely, yes, it's just 5%.
Well, it's interesting you say that, because I'm not quite sure I agree with you on that. Because I think, actually, sorry, just have a little quiet conversation here. Because I think the problem here is much more, because it is relatively small by relation to the overall capital requirements. I think the issue is much more to do with the fact that the new proposals come in and actually penalise very specific products and specific lines very much worse than others. So they actually, instead of making it really, really bad for banks, they actually make it really, really bad for the service that's provided into clients in particular areas and particular spaces. Sorry.
No, that's a good, and that is actually one of the questions we might talk about a little bit more later, because that could also be relevant for the buy side people here ultimately. But let's delve a little bit deeper into what are some of the issues with these proposed new regulations.
Let me take that. So the issue with this new regulation, the problem, I guess, is that FRTB has a lot of components, a lot of new elements that need to be implemented. We said we need to review the way we got the eligibility for this internal model. There is a new framework for the standardized approach that want to be a bit more risk sensitive, so a bit more like an internal model. There is new requirement for the internal model when it comes to the input that goes into that need to be at higher standard, high quality, i.e. this non-modelable risk factor charge. And there is also more additional charges for the default risk, and to capture the default risk not just on credit products but also on equity products. So a lot of changes that come into play, and a problem is that the rules that we were meant to base these changes on, that were included in the document sent by Basel Committee in January 2016, effectively were not really final, and were full of open points. As a matter of fact, the industry and by ISDA submitted a lot of questions in relation to this BCBS document, hundreds of questions that haven't been yet answered by regulators. So this is a big problem when you want to implement and to invest money in technology to implement these new regulations. So this is a big problem that banks are facing, and you need to deal with the uncertainty, and so you need to bring more flexibility and more money on the top of the changes that already require more money. Hence, everything become very expensive, and services that we provide become even more expensive. That's a big problem that we have, definitely. So if we can overcome this clarity issue, so if we get more clarity by the regulator, and hopefully by end of this year we hope to see some new texts coming out, and we can start planning better our work that hopefully will solve partially our the issues. And I guess the other point that I want to make is that FRTB is fundamental for a reason, because it's not just a change in the methodology or in the way or in new infrastructure we need to build, but it's also a change in mentality within the banks, because we need to get departments working definitely closer to each other.
Risk and finance.
Yeah, risk, finance, front office, the business. Otherwise, it's very difficult to overcome the challenge of the new regulation. So,
Well, I think it might be worse than that, mightn't it? I mean, part of the problem with this is that
we have an optimist.
is that you know, part of some of the things, that features of the model have you dropping out of models subject to relatively random tests, and it has desks dropping out, not risk factors dropping out. So actually, for most people working in a markets environment, the capital requirements for an individual product within a desk or between desks for the same product become completely unpredictable. And so rather than, as Neels sort of highlighted, the ambition of regulation to actually align risk and capital, in practice what we have here is a regulation that in its current format doesn't do that at all, and in fact forces you to a position of complete randomness. It's probably not too generous a way of putting it. So I'm worried about the overall capacity of people to manage within that spectrum. At the moment, there are some bits that, as Neels mentioned, that actually are being completely rewritten, which may well change both the nature of the text, but also the nature of the tests that are involved. So it's not a lost hope, but at the moment it doesn't look very rosy.
And I think timelines are pretty challenged as well for that reason, because some of these issues that are maybe being rewritten involve fairly fundamental infrastructure decisions among other things, and that needs time. That we are talking about timelines of years probably to get this right, and well, it's unlikely that.
Well, it's estimated it would take each bank about 2 years from having rules to implementing it. OW about a year and a half ago did a survey reckoning that the cost per implementation was going to be about $200 million per institution. That, faced with the fact that regulators are saying that they didn't really want any change, particularly in capital requirements, does leave you scratching your head a little bit about why. Why would you do that? But anyway.
I think when you're talking about technical regulations, it can easily, as I said earlier, have unintended consequences. Those of you familiar with stressed VAR at the moment, I think that's a good example. It's a good general idea. Hey, let's have another chunk of capital that's based on a VAR model calibrated to a stressed period. But when it comes to actually implementing that, of course, there's a raft of very technical issues: availability of data, models breaking because of large shocks, choices. How do I calibrate this? Can I do this? Can I do that? If you're a regulator, it becomes a really difficult issue. How do I keep a more or less level playing field when there are so many technical choices? And this kind of multiplies that. I think that is a pretty big problem. Then on top of that, of course, in the context of Basel III or Basel IV, as some of us are calling it now, being finalised, there are, of course, several other quite significant bits of regulation either finalised or being finalised. So, Jason, could you give us an overview of a few of those?
Yeah, no problems. Well, when you say regulation, obviously I could have a huge list in front of me, so I'll pick out some of my favourites, I guess, to talk about here. I think, as Mark mentioned, FRTB, I think, is one of the biggest organisational challenges that banks face, even if it's not necessarily the biggest capital piece that the banks actually hold. So it's putting banks under extreme pressure operationally across the whole organisation. In terms of how that fits relative to other regulations, I guess from my perspective, I tend to look at quite a broad spectrum of regulation. I'm thinking of relativity in terms of timing, impact, and I guess the potential of those regulations to change as well, because as we've discussed here, a lot of these regulations are subject to quite a few fundamental changes as you go through, and one change in a line of text can change the numbers by billions. You know, it's pretty extreme. So in terms of, I think leverage ratio is a critical new regulation that banks are facing. I'm sure people in the room are aware of it. It's a non-risk-based capital measure, which is a bit unheard of, I think, but you know, obviously came out, and so it looks at the total balance sheet and it adds in exposure for derivatives, adds in exposure for things like undrawn commitments, and then looks to make sure you've got enough capital to cover that, and sets the ratio anywhere between 3 and 9%, even in some cases, but up to 5%. That creates a number of problems for any bank, because you're looking at the same business with two lenses. On one lens, it can look great from a risk perspective. On another lens, under leverage, you can look pretty poor. So that forces a real, it pushes real difficult factors down into how you manage a business. And obviously, whilst banks want to assess each business on a logical commercial basis, there's also only so much capital that a bank holds. So you have to try and make sure that the whole thing fits together. So I think that's one thing that's really, something all the industry is grappling with at the moment, and that's in play now, being reported now. And the other one I think that's it's very critical now, stress testing. Whilst not a regulation in its own right, you end up having to pass all these regulations and levels under stress as well. So you might meet the hurdle today, but then the regulators will come along and stress your whole position and say, well, you need to meet that under stress as well. So whenever you're thinking about business, you're also having to think, okay, what does it look like now? What could it look like in 3 years' time? So there's another second or third dimension to the difficulties. Because for me, the impact of those two regulations is very high. I think for leverage, I think the potential for that to change, as I'd say, is medium. I think there's a lot of water to flow under the bridge where that regulation is concerned. Stress testing, again, high impact. I think the potential for that to change materially is potentially low. But having said that, I think the US have come out and made some comments about how they want to deal with stress testing more recently, which I think we'll get onto. The other areas that I think are worth calling out, net stable funding ratio, where again that's in play now. Liquidity metric to make sure banks keep enough kind of long-term funding. That's got a high impact, and I think the area that I see from most is around derivatives, where you're required to hold 20% of your derivative liabilities as long-term funding. Now, interestingly, there was just to show the potential for change. That was recently, the Basel Committee came out, I think, this week. I think 2 days ago, and said actually, if regulators want to, that can be 5%. So that shows you the kind of swing you can see on the kind of numbers that banks are dealing with. So that's another big important metric. I'll flick off through a couple of other ones. There's another standardised approach to counterparty credit risk, which is in play now. I guess everyone's got different views on the timelines for that. Recently, I think the EU have given us a couple of years grace for implementation, which is similar to FRTB. So I see that's coming a bit further down the line. Will depend by institution, but I think the impact on that is probably medium, depending on your portfolio, etc. Chances of change around that, I think it's probably at the lower end. It feels like it's been out there for a while, but I guess my fellow panellists might disagree. And then I think FRTB fits within that. I guess in terms of timing, it feels like it's coming potentially 2020. Very high impact, both from an infrastructure perspective, the change in the organisation. But I think in terms of the potential for it to change, I think that's very high. Again, we'll probably get onto some of the potential for changes in latter questions. And then right at the end, you've got capital floors, which I'm not going to make too much comment on, other than saying after doing all this modelling, after going through all this pain, then the regulator will ask you to calculate everything on a standardised basis and cap you at a level to your standardised capital, which might make you wonder why you bothered. But we'll see.
I can see you itching to say something.
So on that note, I'll hand it over.
Poor old Jason, you got the rather long straw there of things that are actually happening. I completely agree, and I think that essentially, if you didn't get a clear enough message from that, there isn't anything that's going to be calculated the same way in 5 years' time, is the message. So it's each of the areas of capital requirements are changing, and obviously you've got the continuation of changing of definition of capital itself. So it's a tricky environment into which to operate. The one thing, given the previous talk, you didn't mention was actually interaction of Brexit. And it is important to recognise that actually banks will have, or certain banks will have a lot more work to do as a result of Brexit, probably. Whether it's actually setting up banks and therefore getting regulatory approvals for those, getting model approvals, because effectively to be a big bank, you will not be an effective participant in the market without these model approvals. So the model approvals for these are, as Neels was mentioning at the beginning, very complex and very long. So actually you're in a position where you're having to do all the setup, and then you're going and having to submit models to in the case of the ECB, to a regulator that's quite new at dealing with this. And is trying to set out very clearly what it's actually trying to do and how it's trying to perceive regulatory model submissions. But just by dint of actually doing that, it's very clear that they haven't done very many of them.
Yeah, I think the other point, if it didn't come through with that quick run through of regulations, is how much we have to live in the grey, as it were, in terms of a banking institution when you're looking at business and trying to understand how it makes sense. And a regulation comes out and you think that doesn't make commercial sense, a particular piece of that. So then you kind of you generally have to make a call and walk the line between not going not completely factoring in the impact of that regulation and kind of looking for that to change and that piece to go in the right direction. So that this is going to go, I think, be a continuing theme all throughout as these regulations come in. We're going to keep looking and reviewing these on a constant basis.
I mean, it is an interesting point because in fact, since the crisis, there's been this ongoing issuance of statements about what people will go and do, a slight drawback from them, people making initial estimates of how bad it's going to be, then coming back to them. I don't know how many times I went to our head of fixed income and said, I'm afraid we're going to have to shut your business again. It's another regulation that is terminal for this type of business. And then we have a little laugh and we go and think about what that could actually mean and how it could be done better. So yeah, I think this is more of the same for me. Honestly.
Yeah, agreed.
And of course, as we've alluded to, there is great potential for divergence between different jurisdictions. So, although Brexit is an obvious one, I mean, good luck to the PRA rewriting a lot of this, because at the moment, of course, it's all European regulations and so on. ECB is a new regulator. The US, of course, I mean, what's really interesting, I happened to be, when I was at the FSA at the time, I was involved in very early discussions on what became FRTB, and this model workstream at the time was chaired by the Fed, and they were very keen on these new models. But what was clear at the time was they were not keen on the degree of diversification between different asset classes that banks have at the moment. But where we've ended up now is that there's this impasse between particularly Europe and the US, and I think mainly the Fed on the US side, on what Jason alluded to earlier, capital floors. So some regulators are not keen on internal models at all. You can have your own views on that. So and their remedy to this is to limit the benefit in terms of capital saving that banks can actually get from having this in internal model, and that is done via saying, right, your capital at the minimum should be 75% of what the standard charge would have been, which for a lot of banks means it's probably not worth having an internal model. You can maybe make a better than me, but your savings, for all the money you need to spend, your capital saving ultimately under these floors might be quite minimal. So at the moment there's a bit of an international standoff at Basel level between these different regulators, and there's some horse trading about where the level of the floor might end up.
There are a couple of things to say on that. One is the floor isn't agreed yet by anybody, and there is the current rumour is it's going to be about 72.5%. But also that it's not really sensible to actually apply it to FRTB in any case, because FRTB already has its own kind of natural inbuilt sort of default. If the models stop working, the intention is to have mechanisms, which they don't work at the moment, but which will probably work in future, which will drop out things that don't fit that to a standardised approach. So it doesn't actually make a great deal of sense to have that in. Actually, what would make more sense in FRTB would be to have a cap, so you don't actually have to put more capital up than the total value you could lose on the products you're actually holding.
While on that theme, does anyone want to talk a little bit more about other jurisdictional differences, or I mean, I'm thinking about Volcker, for example, that's got its own desk structure, and FRTB will have its own desk structure, but there could be sort of jurisdictional challenges as well, to if you're a large bank, to
definitely there will be. The thing is, the thing to consider also is that how FRTB will be applied. If we consider that a case where we know that the US may be reluctant to apply FRTB at a later stage, then this will delay effectively FRTB for everybody else. Maybe because maybe the ECB will not want to push for FRTB, even if the message received up to now are different. So the thing is, for sure, this the different view across jurisdiction of how and when FRTB need to be implemented, it's a problem given that introduce even more uncertainty. And again, it's going to happen, or when it's going to happen. So it's again a big problem if you need to implement the rule. And then when you read across FRTB, and there is there might be difference across jurisdiction, because, for example, when it comes to the default risk charge, certain jurisdiction may decide to not apply, or they may have the ability not to apply that charge on sovereign products. For instance, maybe the US may just say we don't need to charge sovereigns, and this doesn't make sense for us, and for the default risk charge, and instead in Europe they may ask for sovereigns to be applied. Clearly this will create an even playing field, and then again it becomes political, the discussion. Do we really want to do that in Europe? So again, there's a lot of uncertainty that it's introduced by the FRTB rule itself, by the regulation that we read at the moment. So,
I think we've seen an example of that with the US move to kind of exempt treasuries from the leverage ratio. So I think they've unilaterally said, well, we won't put treasuries into that measure now. So I completely agree.
There are other jurisdictional things which Basel essentially, because it tries to act for groups of banks, often doesn't think about below that level structure, and so there are some oddities in FRTB as well. Which, if you have a group structure which consolidates, where you have banks with trading books which consolidate into others, and say you have a bank in Vietnam. Well, excuse our example, we have banks all over the place, but we have a bank in Vietnam that consolidates into a bank in Hong Kong that consolidates into the group in the UK. And that means you've got a Vietnamese dong bank, you've got a Hong Kong dollar bank, and you've got a US dollar top level. In FRTB, they design the risk factors for even the standardised approach with relation to your reporting currency. So even the risk factors that are used in the core computations of this are different at each level of consolidation of the group. So it's not just to do with the fact that people might implement things at the same time frame, but even if they implement them at the same time frame, you necessarily get a different result because of the way the rules are defined at different levels of consolidation. Even if you've got the same positions at each level in the group and no others. So there's certainly some things that need a little bit of sorting, a little bit more thought, really.
Great. As a final topic, and seeing that there are many buy-side people here, what do we think about the the impact on the buy side of this, and I guess extending that a bit on the industry as a whole. I mean, we've seen that certain asset classes might be harder hit than others, although the rules are not final yet. But there is certainly that element. What do we think?
Well, maybe it's worth giving a couple of examples. There are a couple of things, and obviously all of these rules could change. There is a school of thought that says in early next year there's going to be another consultation which will pick up a load of these issues that have been sort of are inappropriately sorted at the moment. There's another school of thought that says there'll be marginal changes that will be announced and through FAQ. So we actually don't know what the score is. At the moment, the calibration is peculiarly bad for currencies that are not major currencies. It's very, very badly calibrated. So if you happen to want to access emerging markets or have an emerging markets presence, it's very tricky for you. There is also a kind of threat that's emerging through the index discussion that's actually going on, because the calibration at the moment of FRTB is peculiarly bad for interest rate product basis risk. At the moment, you're probably aware that most derivatives in the world are actually based on and priced off either LIBOR or OIS curves. But in the future, of course, LIBOR won't really exist. So you'll have banks with books either running off or being replaced, some of which are LIBOR, some of which are OIS, some of which are new basis computations. And if these are badly calibrated, this is going to be devastating for the cost of generalised interest rate risk to the banks themselves. It shouldn't worry as a buy side. Are you bothered about banks' costs increasing? We've already said it's a relatively small number. The point is, banks do tend to cascade their thinking about capital costs through to the business areas, and it will tend to make those business areas look worse. It's always a matter of allocation. You can't actually calculate what the capital requirement is for any particular piece of business. It's always allocation. But when they allocate it, they'll say, this bit looks really, really bad. Are we going to absorb that and service customers, or are we actually going to say, let's scale that back a bit and let's actually do the bits that don't look so bad under this measure? So in terms of the buy side, depending on what aspect of the buy side you're in and what extent to which you want to use derivatives, there may well be some effects.
Yeah, I think also at a basic level, because of the sort of operational complexity of this regulation, I think whenever these regulations come out, it forces banks to reevaluate their overall strategy. And I think if you've got areas of a business that aren't, I guess there isn't enough volume, for instance, there isn't a lot of transactions, and it's a bit more bespoke. People are going to have to look at the investment required to kind of substantiate, the investment in these areas, and the proof that's required about, whether the product trades, 24 times, etc., etc. There's going to be a whole weight of infrastructure required to support this. Now, if you get it, implemented in the right way, then in theory, a lot of the product can flow through it. But I'm sure there'll be areas where banks will have to think carefully about what products they offer. So there may be, I guess, less counterparties offering certain products at a margin potentially.
The other thing that could happen is that the point that Jason's alluding to is this non-modelable risk factor concept, where you actually have to prove that pricing exists for a product a couple of times in a month and various other criteria. And the issue with that is that it could also encourage spurious price making between banks, where they make artificial prices just for the point of getting a marker and a comparative pricing in order to prove that the thing is a modelable risk factor, because the penalty of not doing so is very extreme in the models. So you could find that actually markets are very thin ice, and when you start treading on them in the buy side, you go through it.
And for sure, I mean, thinking about this non-modelable risk factor, they definitely more structured, more complex product or less liquid product will be less and less liquid, because it will be very, very expensive very difficult to trade them, and because they require more capital, definitely. So definitely for those, probably we'll see more liquid product under FRTB, and will be very expensive or less illiquid product, less structured product, less complex product.
I think interestingly, there's been studies that have pointed out that even for relatively liquid products, over the summer holidays, periods like that, you don't necessarily get enough observability, even when you think the product is quite liquid. So that's an interesting.
There's another area that might affect buy-side in actually bizarrely in a slightly different context, which is the default risk charge, which is one of the two key components. One deals with small variabilities, expected shortfall. The other with default or jump to default effective things. Is that there's a floor in the DRC method of 3 basis points, which implies that actually you'll be disincentivized as a bank from holding the very best quality assets. So actually that sweet spot where you'd hope to see most liquidity naturally coming and being facilitated from banks, there's most incentive not to hold those in a trading book and make them readily available. So you'll be holding the slightly less good stuff for high quality liquid assets rather than the best stuff. So you might find a strange effect in liquidity to the extent market makers, and you believe market makers have any value in this market, which you might not, of course, believe.
Well, I think let's go to questions. If there are any questions? Stunned silence.
Hi, going back to I think the point you touched on towards the end there. Do you think some banks then will think that this is just too arduous and they're too much at the margin whether they make any money out of these products to say we'll just go towards standard and we'll back away from being market makers or price providers because it is just too laborious to do so?
It's very expensive to do that. It's very expensive not to go for the models. So although we're talking about, again, relatively small numbers, if you have to put up, say, an extra 10 billion or 20 billion of risk-weighted assets, and you usually make a return of, 1.5% to 3% return on risk-weighted assets, you're giving up a lot by not applying for models. So you're kind of in a very awkward position. Will you withdraw completely? Yes, that's going to be the obvious suggestion to people, is that you're presenting me with a bill for $100 million to build the system, and then you're saying it's going to take you another 20 million to maintain it. And then how much business are you going to do? Oh, about 50 million. Well, most CEOs will be scratching their heads thinking, oh, I've got about 3 years to break even, maybe 4 years to break even, and it starts in 4 years, that's 10 years. I'm not going to be here in 10 years. Why should I say yes to that? So it will be a balanced thing for many medium-sized and small houses.
That's the category I was thinking of, medium-sized banks.
Yeah. I would imagine most medium-sized banks will not go for models.
I think, sorry, I could quickly add to that, I think from the regulatory side, you can see that, again, for the big banks, I think we can realistically expect a bit of regulatory push, saying, look, if you have models now, we expect you to continue in that direction. We're not going to allow you to just go to standard, because then we've still got Pillar 2 to hit you on risk management deficiencies and all those things. So I think that'll add to the balancing act.
Yeah, I think I'm going to kick myself for doing this, but to mention a real positive thing about the fundamental review of the trading book, I think when I first read it, the idea of getting everything onto kind of one risk engine, whether it be front office risk, market risk and reporting, is a really worthwhile thing to do for any organisation or bank. It's going to be more cost effective. It's clearly the right thing to do. So I think banks will be driving towards the infrastructure you need for this, but it's just the way, it's all the difficulties we've described here that are going to make things around the edges more difficult to do. So to the extent they fit within that, I think, I'd say even some medium-sized banks will be, or medium-sized banks and below, will be driving for this, but then people will have to make decisions at the margins on it would be my guesstimation.
Yeah, I agree. I think there's a point up to which you can say this is clearly good risk management practice and better data quality, all these good things, but then beyond that, you need to go down modelling rabbit holes that are not clear at the moment. There was another question over there.
2 questions actually. So we've been learning about the timelines are being pushed for FRTB. So first question is, what do you think realistically would be the new timelines for implementation? And second question is that there are two parallel frameworks in terms of CVA framework and the FRTB framework right now. Do you think in future the CVA framework will merge into FRTB framework or vice versa?
Who wants to take this one?
I mean, essentially, the Basel Committee believe their revision to CVA framework. By the way, this isn't CVA P&L, this is CVA risk, so it's RWAs associated with CVA movements. That framework, they believe they've already got it ready, and they're just ready to roll out as soon as they've agreed the floor with all the other pieces. So that should be relatively soon coming, and the idea was that it would drop in, as you suggest, into the market risk framework and be another part of that framework. We don't know exactly how it will be because I haven't written the rule yet, or we haven't told us.
It's a good guess that it'll be very similar to the standard part of the market risk framework. I think the advanced modelling option that there is at the moment will likely fall away ultimately. Timeline, who wants to? I can have a go.
Yeah, I'll have a guess as well.
I think, I mean, if you look at Europe, so the current European regulation, the advertised timelines are 2 years after finalization of the new framework. Now, it's not final yet. I think end of this year is the best possible outcome, and it probably won't happen. But if it happens end of this year, then 2 years, that takes us to the end of 2019. And so it's at least a year later than originally advertised. Let's say end of 2020, would you say, is probably the absolute earliest time this could happen, and it will probably slip.
Then the big question is which jurisdiction? Again, US. It's not clear when, if they will apply, and the European jurisdiction, a lot depends on when the CRR will because the FRTB, which is the guidance, and to be translated into CRR, which is the law, and then so that need to go in live, and then FRTB will be binding. So 2020, but maybe even later.
Actually, I've got to slightly add on to that. Part of, as you know, in Europe, part of the rule is, first of all, you get the level 1 text, and then you get the regulatory technical standards, which give level 2 text. Unfortunately, the way it's currently crafted, the EC crafted it so that some of the level 2 RTSs, which are required in, even the ones in 2 years, actually have things that you actually need before you can put in place some of the technical elements of the submissions that you might or might not have to make. We're not quite clear, but certainly the standardised risk factors are not fully defined until after the 2-year RTS, and there are some other components of it that are not defined until 15 months later. So if you think about a rational timeline, the EC had tried to push the timeline out as far as they thought was reasonable, but actually even they have recognised now that it's not really doable in a 2-year time horizon. So I think it would be 3 years in any case.
That's being moved, isn't it?
So that's 2019 goes to 2020, 21, 22, Jan 22, say. Probably the earliest Europe could realistically expect people to do it. On the flip side, the ECB sent round a note with their sample timeline about 2 weeks ago, which is, it's not quite clear what the distribution list was, but there was a public call on it. And their timeline had people submitting the models from mid-18 through to end Q1-19, i.e. before you've got the rules. So, you know, I mean, it was probably up there for discussion, and it was certainly there for discussion. And they had said that what they'd done is they'd worked back from the end dates, and they'd worked out that this was when it was necessary. And it doesn't take a rocket scientist to work out that that doesn't work, and it can't work. You can't sort of submit things with back testing and have a tick back against the rules to prove that you complied with the rules before the rules are written. So it's as long a piece of string, this one, really. And that makes it tremendously difficult. It was worth thinking about cost-wise. I talked a bit and mentioned OW saying it's about 200 million. some banks would be starting this, and you'd think, well, okay, you might spend, say, you might be trying to get away with only spending $50 to $100 million. If halfway through spending that, you suddenly find you've got to keep going for another 2 or 3 years, or alternatively, that you've got to speed up your plan by 2 or 3 years, your costs will multiply very quickly. So this is, yeah, it's a watch this space on the costs as well.
Last question.
You talked earlier about the knock-on impact on the buy side. How much of an opportunity is this for the buy side, and if so, in what way?
Well, there's been talk of buy side taking over more functions currently with the sell side for a while, but that's kind of regulatory arbitrage, I suppose. So how long before that gets?
I mean, my knee-jerk reaction would have not been to answer it about in that direction, but to say that actually one thing we've said is that capital won't be the same for any bank, for any instrument, and potentially within the bank there will be different prices based on capital at all, which it might not be going forward or might not be now. So you'll find price differences much more frequently throughout the markets. And that's going to be, I mean, on the flip side, you could view that as an opportunity. Oh, there's pricing differentials. On the flip side, you could say, well, fragmentation inevitably lower liquidity, and therefore is less an opportunity.
Yeah, no, I had that written down. I agree with Mark there that, you know, because of all the other regulations we touched on earlier as well, you know, different banks have got different constraints, different capital costs, and yeah, I think you're going to just get a much more variable field. If you don't already get that now, I think it could become increasingly more variable.
I mean, there could be opportunities as well for asset swapping into different asset swaps and the sort of improvement of collateral trades and sort of asset for asset trades, which could become worthwhile doing. But that's not really so much FRTB driven, more perhaps leverage and NSFR potentially driven.
Yeah. We wouldn't want to tell you too many.
I mean, you've seen some hedge funds creating arms that do market making and swap market making, so that's been happening anyway. But again, is it FRTB driven? No, not really.
Yeah. It's not a good message, is it?
Okay. Thank you very much.
Any other questions?
No, there was one more there. If you've got time.
There was probably more an observation than a question. So, the massive amount of complexity that you're talking about.
Could you flip your microphone forward so it's
yeah. So sorry, it was more an observation on everything you just said than a question. So, because of the massive amount of complexity that you're talking about, some of which doesn't make sense at the moment, and it's not just in FRTB, you probably find it in some of the other aspects of risk-weighted asset calculations, etc. I mean, I would challenge any CEO to understand how his capital is determined when he's looking at his statutory accounts, because it's based on 1 billion different calculations. But anyway, when you look across corporates, and it doesn't matter what sector of corporates that you look at, they typically carry around 30 to 40% of assets in capital. And across Europe, including the UK, banks, and just by taking total capital on the balance sheet against assets, carry around 6%. And you ask yourself, well, why is there such a difference? MREL is supposed to get you somewhere close to where the corporates are, but through socialising bail-in debt through the tax system, why add that complexity when the corporates don't have it? So, as well as having this low amount of capital that's against the assets as they currently stand, you then have to add in all the regulatory oversight, the capital plans, liquidity plans, recovery resolution plans, stress testing, asset quality reviews, all around the fact that banks carry so little capital. So I can understand why the regulators are forcing complexity around complex structured instruments, because they don't want banks to carry it. And to one of your points, push it out into the market and start peanut buttering the risk across the whole of financial services. So why not have hedge funds or other type of institutions carry these type of transactions and not consolidate it and have it locked up in what is a relatively very narrow industry? So peanut butter all that risk and then push banks back to something that is highly profitable, which is serving the retail market with traditional lending. It was just an observation because all the complexities you're dealing with and talking about and timelines and all this stuff, and you would think it all comes down to the fact that banks don't carry enough capital no matter what way you look at it.
But it's interesting that actually they're not pushing back and actually asking for more capital in this space. In fact, it's been one of the tenets that they've said is actually they're not trying to generate more capital out of this. So that, and
I realise that, but look at the type of cost they're going to push onto you and the way that they're going to manage that volatility in falling out of models, going to standardise, trying to get back again, rearranging your desks. There's a flaw in the way that banks are structured strategically. They've got very high cost bases, which means they can't really do a very good return on capital. So therefore, they're pushing to have as low capital as possible. And it's very hard to explain that differential between 6% and 30% that corporates carry. Yes, MREL will probably get you a lot of the way there, but with a complex process of bailing in debt, which hasn't even been tested yet. They did have an instance in Italy where people were committing suicide because they bought bailing debt which shouldn't have been sold to retail investors. So all this type of stuff adds up to the fact that there's something wrong with banking models that needs all this stuff allocated to it to ensure the banks don't go bust and take the rest of us down with it.
I can understand a lot of your sentiments certainly there, but I'd say that just for the complexity point of view, I mean, for some books we're just talking about bonds and equities. This doesn't need to be complicated at all for it to generate these requirements.
I realise that these regulators are not stupid. They're doing this for a reason. I mean, we just had it 10 years ago. That's the reason.
Yeah, I think we'd all agree with your sentiment. You know, I think things had to change. You know, I've been part of a bank that's looked at kind of revamping this model, you know, getting more client focus, getting out of certain businesses. So that a lot of that thinking's happened. I'm sure a lot of banks. I think one observation I'd make on the capital comparison is I think depending on what bank you're talking about, clearly that some banks hold a lot of, I guess, government bonds or I guess repo transactions on their balance sheet that are extremely low risk. So
you know what? Every asset carries risk.
Correct.
Correct. What pulled the Greeks down was owning government debt.
Yeah. I think that's I guess how the bank models have been built, and still are to this day, even under the current regime, they consider sort of certain assets.
I don't think any asset is riskless.
So I think you're probably a proponent of the leverage ratio then.
Not really. I think that's
a good answer.
I think that's just another layer of complexity that, you know.
But I guess that is trying to simplify because in there all assets are the same and they're saying carry a level of capital, but you're saying the capital level is too low, right? So you'd be saying
so the same. I'm sorry to drag this out, but the same risk, credit risk that a bank will apply to you to take a mortgage out is not the same that they apply to themselves. So under the current regime, forgetting about 100% mortgages, they want you to carry 25% of your own equity in your house. Why wouldn't banks have 25%?
We've had enough there, so thanks for listening, everyone.